Welcome to all of you Shiksha 360. And today basically we will discuss the chapter number 6 part 1, that is credit scoring. Clear, that is credit scoring. Very important for the examination point of view. Clear, every year basically you will find that 2 to 3 questions basically from this chapter. Clear, and all questions are straightforward, but you are able to attempt these questions only if you have already go through the chapter once. Clear, otherwise, because we know that regarding the credit scoring like Siebel Equifax, clear, but there are some technical points in that also. So basically we have to discuss all the technical points in this session. So let's start our discussion. So basically, as said by Mr. Greenspan, so you have to also remember, clear, basically this point is given by which person. Clear, basically risk is embedded in every action and inaction, and the best way to counter the risk is to manage the risk in a professional way. Clear, so basically as per the Greenspan, basically risk is embedded in every action and inaction, and what is the best way to counter the risk is to manage the risk in a professional way. Clear, in the examination basically they will give the line and ask basically which of the person is, this line is given by which of the following person. Clear, so you have to remember that by the Greenspan. Clear, risk is embedded in every action and inaction, and the best way, clear, and the best way to counter the risk is to manage the risk in a professional way. Clear, is to manage the risk in a professional way. So to manage the risk, clear, to manage the risk, basically we have to understand, clear, to manage the risks, we have to understand the different types of risk. Clear, to manage the risk, basically we have to understand the different types of risk and how to mitigate and how to reduce the risk. Clear, first of all, basically we have to understand the different types of risk, clear, basically which we will face, and after that only we can find out the solution. Clear, basically how to reduce that risk. Clear, how to reduce that risks. So to manage the risk, basically we have to understand the different types of risk and how to mitigate the risk. Basically in the retail side, clear, basically in the retail side, the types of risk as applicable for corporate credit, as applicable for retail credit also. Clear, as applicable for retail credit also. Clear, so basically what are the types of risk? The types of risk and the triggers for the risk are mentioned below. Clear, the types of risks and the trigger for the risks are mentioned below. Clear, first one is the credit risk. That is basically when there is credit risk, basically when the customer fails to pay. Clear, basically when the customer fails to pay, that is basically known as the credit risk. Second one is the business risk. Business risk is what, basically when the basically when losing money basically due to the wrong strategy. Clear, business risk, it is when losing money basically due to the wrong strategy, and credit risk, it is when the customer fails to pay the money. Third one is the market risk. When there is market risk, basically change in market prices. Clear, market risk, it is when basically when there is change in the market prices. Last one is the operational risk. Operation risk, it is when basically processing failures and frauds. Clear, basically processing failures and frauds. Clear, so that is basically comes under the operational risk. Clear, that is basically comes under the operational risk. Clear, so you have to remember that also. Basically the types of risk: credit risk, basically when the customer fails to pay; business risk, basically losing money due to the wrong strategy; market risk, basically due to the change in market prices; operations risk, basically processing failures and frauds. Clear, operation risk, basically processing failures and frauds. So basically this is a diagram given in the book. So basically same thing, basically business risk, basically losing money due to the wrong strategy; credit risk, basically when the customer fails to pay; market risk, basically change in the market prices; or last one is the operating risk, basically processing failure and frauds. Clear, processing failures and frauds, or we can say that the regulatory compliance. Clear, regulatory compliance. Clear, basically we are not complying all the guidelines. Clear, in that case also basically operating risk is happen. Clear. So next one is a credit score. Clear, what is the meaning of credit scoring? Clear, so basically every borrower, clear, like if you are visiting the bank, clear, while for taking the loan, clear, so basically you want that less to less interest will be charged on that. Clear, less to less interest basically will be charged on that. Similarly, but the lender wants that basically more and more money they will earn from that. Clear, more and more money basically they will earn from that. Clear, so every borrower seeks the lowest interest rate. Clear, every borrower basically seeks the lowest interest rate, and every lender basically has the highest. Clear, seeks the highest. So the return of a lender basically seeks factor in apart from his profit a premium for the risk he feels he bears of not being paid back. Clear, along with the profit. Clear, basically while giving the loan, along with the profit, basically the lender basically wants the premium for the risk. Clear, basically he feels he bears of not being paid back. Clear, of not being paid back. Clear, like basically we can say that insurance. Clear, basically we can say that like insurance. So basically this risk perception is different for different borrowers and ideally should be determined, clear, and ideally should be determined from their credit history, clear, ideally should be determined from their credit history, clear. So the lending bank can judge how good the borrower, clear, the lending bank basically can judge how good the borrower basically can be by sourcing their credit score from different agencies, clear. Basically there are different agencies present in the market basically who give the credit scoring, clear, basically on the history of the borrower. So in this context, basically credit record of the applicant is crucial because a credit score can make the loan friendlier with the lower rates, clear. If the person has good credit score, like basically we can say that above 750, clear. So basically it means that interest rate basically the bank will charge low, clear. If any other person basically have low credit score, so the bank will charge more interest, clear. So in that case the bank will charge more interest, clear. So a lending bank can source the credit score, clear. A lending bank can source the credit score of the applicant from credit information agencies to supplement the information they furnish in their loan application, clear. Now if any applicant had already defaulted on a loan from one bank, clear, if any bank person basically taking loan, we can say that from the PNB, and now that person is visiting the basically Bank of India, they have already defaulted a loan of basically rupees 2 lakh in the PNB, clear. Now basically they want to BOI basically for a 5 lakh loan, clear. So basically when they will see their credit histories, they will find that basically the person had already defaulted a loan in PNB of rupees 2 lakhs, clear, of rupees 2 lakh, clear. So basically a lending bank can source the credit score of the applicant from the credit information agencies basically to supplement the information they furnish in their loan application, clear. Now if any applicant had already defaulted on a loan from one bank, the default would bring down the credit score, clear. So this default basically would bring down the credit score which any other lender would also be privy to, and it could determine not only whether the applicant would get a loan or not, but also the rate of interest, clear. So basically now it depends upon the bank, clear. So and also depends upon the credit score, clear, basically whether that person is eligible for that loan or not, clear, because their credit score basically gets lower down due to that default done by the customer, clear. So this is the importance of the credit scoring, clear. This is the importance of the credit scoring. Now let's discuss basically what is a credit score, clear. Basically what is a credit score, clear. From this also basically we will get one more question. I will tell you basically from where basically we will get one more question. So credit score, clear. First of all basically we have to understand basically what is a credit score, clear. So a credit score is the statistical analysis, clear. A credit score is the statistical analysis of a person's past credit, clear. So what is a credit score? Basically it is the statistical analysis of a person's past credit dealings and represent his or her credit discipline, clear, and represents his or her credit discipline, clear. So the credit score is assessed, clear. The credit score is assessed basically based on the dealings in the credit products like home loans, auto loans, personal loans, and overdrafts. So credit scores can be generated, clear. Credit scores can be generated by credit institutions and even by self, clear. Credit scores can be generated by the credit institutions and even by self, clear. Basically you can also get your credit score, clear, basically by logging into the Google, and after that basically by going into the page of any credit scoring agency, clear. Or there are also multiple apps basically they can also provide you credit score, clear. So basically Reserve Bank of India, further from this you will get one more question. So Reserve Bank of India basically has made it mandatory for all the credit information companies in the country to give a FFCR, clear. First full form basically they will ask in the examination, what is FFCR, clear. FFCR, free full credit report, clear. Free, F for free, F for full credit report, clear. So Reserve Bank of India has made it mandatory for all the credit information companies in the country to give a free full credit report without any charge, clear. Basically without any charge on request once a year, clear. Basically without any charge on request once a year to individuals whose credit history is available, clear. Basically not to charge any amount from the customer, clear. So and when this rule basically comes into play, basically this rule has come into force from 1st of January 2017, clear. And then basically when this rule comes into force, this rule has come into force from 1st of January 2017, clear. This rule has come into force basically from 1st of January 2017, clear. This is very, very important for the examination point of view. So basically a credit score, clear. Next one mark question basically from here. So a credit score basically it is how many digits. Here a credit score basically takes a snapshot of a consumer's credit report and through advanced analysis and turn the information clear and turn all the complete information basically into a 3-digit number clear. So basically credit score it is of how many digit, basically 3-digit number, and what is the range of that also clear, representing the amount of risk clear he brings to a particular transaction clear, representing the amount of risk that the customer brings to a particular transaction clear, that the customer brings to a particular transaction. For instance, the CIBIL TransUnion model, clear, the CIBIL TransUnion model, this is one of the credit rating agency, clear, credit investigation company, clear, we can say that credit agency. So for instance, basically the CIBIL TransUnion model gives a score basically ranging from 300 to 900, clear, 300 to 900. The higher the score, the lesser is the risk of the consumer, clear, the higher the score, the lesser is the risk of the consumer, and lower the score, more is the risk under that, clear, and lower the score basically more is the risk under that, clear, basically more is the risk under that, clear. So now evolution of the credit scoring, clear, basically how this process involves, clear, basically how the process starts of the evolution of the credit scoring, clear. So let's discuss regarding that. So a credit bureau, clear, basically here basically in this basically they have discussion the scenario of different countries, clear, basically how the default occurs in different countries, clear. So you have to go through that one, clear, basically how the default occurs basically in different countries basically due to the non-checking of the history of the borrowers, clear. So what is a credit bureau, clear? So basically evolution of credit scoring. So credit bureau, clear, a credit bureau or credit agency or an organization basically tracks the indebtedness, clear, and repayment history of the individual borrowers, clear. Credit bureau basically tracks the indebtedness and repayment history of the individual borrowers on loans that they have taken from the banks or non-banking financial services companies and financial institutions, clear. Basically they will pick all the record of the customer, clear, basically from where they will know regarding all these things, clear. Basically they have to acquire the KYC documents, clear, which we have to be discussed in the next paragraph, clear. It also contains personal information, clear, it also contains personal information of each borrower, clear, it also contains personal information of each borrower like the name, age, and verified permanent address, clear. It also contains personal information, clear, it also contains personal information of each borrower like the name, age, and verified permanent address, clear, including that basically you will find that basically you have to put ID proof or KYC documents like PAN card, Aadhaar card, voter card, clear, while calculating the credit score, clear, while calculating the credit score, clear, you have to put the details also, clear. So it also contains certain personal information of each borrower like the name, age, and verified permanent address, clear. So the information is collected in a credit information report, clear. So all the information, clear, all the information is collected in a credit information report, which is made available, clear, basically which is made available to a loan issuing member, clear, basically which is made available to a loan issuing member, clear. So the information is collected in a credit report which is issued or made available to a loan issuing members, clear, to a loan issuing members. So using the credit information report, clear, or using the DAT CIR report, credit information report provided by the bureau, bankers figure out they should be able, clear, bankers figure out that they should be able to avoid distress like non-payment of dues, clear. Basically from that basically they will check the record, clear, whether in the past, clear, basically how the person will do the dealing, clear, how the person will do the dealing, clear. So basically from that, clear, if the person is defaulter, so they will not pay or not give the loan to that customer, clear, the lender will not provide the loan to that customer, clear. So the credit information bureau, clear, the credit information bureau basically broadly uses the following weightages given below to arrive at the score, clear. This is also next 1 mark question, clear. So basically to whom given the maximum weightage and to whom given the least weightage, clear. So the credit information bureaus broadly using the following weightage given to arrive at the score, clear. First one is the payment history, clear, first one is the payment history, highest scoring, that is 35%, clear, highest scoring, that is 35%, is given to the payment history. Clear? How the person basically failed the previous loans. Clear? Whether on time they will pay the installments or not. Clear? Second one is the amount owed. Clear? Amount owed. Clear? Basically how much they will borrow money from the banks. Third one is the length of the credit history. Clear? Length of the credit history basically 15%. Like basically what will happen here? Clear? Basically some person basically what they will do, they will open the account in one bank, like we can say that SB. Later on they will close this account and move to the PNB, and later on they will close to the account, they will move to the BOB. Clear? And later on they will close the account, they will move to the ICICI. Clear? So basically this also deteriorates the credit score. Clear? This also deteriorates the credit score. Clear? New credit is to be 10%, and types of credit in use, it is also 10% weighted. Clear? So basically in the examination they will ask this types of question. Maximum weightage is to be given to the payment history. Clear? Maximum weightage is to be given to the payment history, that is 35%. Clear? I request to all of you, please remember all these points. Clear? Please remember all these points, because in the examination they will definitely ask these points. Clear? They will definitely ask these points. Now move to the next one here. What a good credit score. Clear? Basically what is a good credit score? Clear? Basically we will know that credit score basically lies between the 300 to 900. So basically higher the score, lesser is the risk. Clear? So basically whether a score is good or not will depend upon the bank's internal policy. Clear? Basically whether any score is good or not basically will depend upon the bank's internal policy, its customer profile, and its risk appetite. Clear? Some banks may perceive 700 as a good score and another may not. Clear? It depends upon bank to bank. So thus in India basically different banks will rank different scores as good. Clear? Different banks will rank different scores as good. Still any score above 800. Clear? Still any score above 800 will be considered excellent. Clear? Basically will be considered excellent across the board. Clear? Will be considered excellent across the board. Clear? But credit score is only an indicative tool. Clear? But credit score, it is only an indicative tool for managing the risk. Clear? Credit score, it is only an indicative tool for managing the risk and its effectiveness. Clear? Basically for managing the risk and its effectiveness depends upon the bank's internal control mechanism. It depends upon the bank's internal control mechanism. So an objective thing here basically like the credit score will not only help the banks to reduce the defaults, but also make loan dispersing factor faster. Clear? But also make loan dispersing faster. Clear? Basically if the person is good credit score. Clear? So basically we will not look other things more. Clear? So basically as per the loan requirement. Clear? If the loan is in the limited range. Clear? So basically we will disperse the loan faster. Clear? Improve operational efficiency and brings down cost. Clear? And brings cost down. Clear? So all these leads to a good credit score. Clear? All the things basically happen with the good credit score. So basically managing the credit score. Clear? Basically how you can manage the credit score. Clear? Basically as basically we are discussing at these points seems to be very easy. Clear? But in the examination basically when they will frame question, basically you are not able to identify basically what they want to ask. Clear? Or what is the answer. Clear? Because all points seem to be correct here. So basically managing the credit score. Clear? Even if you are paying the installments on time, sometimes the person credit score is low. Clear? Sometimes the person credit score is low. Clear? So now basically we will discuss basically what are the reasons behind the low credit score. So first one is the effective utilization. Clear? Credit utilization. So effective credit utilization, it is a very important step in the individual's credit score. Clear? Effective credit utilization is a very important step in the individual's credit score. Clear? Like basically we can say that if your safe limit is rupees 10,000 and you are using only rupees 5,000, so then you are a very safe customer. Like basically we can say that you have a credit card of rupees 1 lakh, and in the month, clear, basically before the installment due, basically you are using 50 to 60K of your credit card. Clear? So basically then it says that basically you are a very safe customer. On the other hand, if your limit is rupees 10,000 and you are not fully using it but also seeking further credit, so you could be over leveraging yourself and your score could fall. Clear? Like we can say that your credit card limit is 1 lakh and your payment due date is 26th of January. You will pay on that day, and on 27th January, clear, what you will do basically you will take out all the money. Clear? Or you will spend all the money. Clear? And even after that, clear, basically you want more credit from the company. Clear? You want more credit or basically more funds from the company. Clear? So basically it led to your CIBIL score fall. Clear? It led to your credit score falls. Clear? So are the number of inquiries very high? Clear? Basically, like we can say that today basically you inquire your CIBIL score or credit score, and next week also basically you inquire your credit score. Clear? CIBIL is one of the agency. Sometimes I will say CIBIL. So basically it is one of the agency like Equifax. Clear? Basically regarding that basically we have to also discuss. Clear? So like credit score, clear, next week also, clear. If you are continuously inquiring, clear, so this also leads to the fall in your credit score. Clear? So all the number of inquiries very high. Have you applied for additional credit lines recently? Unnecessary and frequent shopping for the credit, or too many new accounts, clear, or too many new accounts can be taken as an indicator of being hungry for loans. Clear? Too many accounts can be taken as an indicator of being hungry for loans and impact the score negatively. Clear? And impact the score negatively. Clear? So you have to take care regarding all these things. Clear? So you have to take care regarding all these things. Clear? That is basically comes under the credit utilization. Clear? That is basically comes under the credit utilization. So next one is the payment defaults. Clear? Next one is the payment defaults. Clear? It also affects the credit score. Clear? How many past accounts are due and by how many days and by how much amount. Clear? The fewer the accounts, it is better. Clear? The score is better. Clear? Payment defaults. Clear? How many past accounts are due and by how many days and by how much amount. Clear? The fewer the better. So trade attributes. Clear? Trade attributes. How old are your lines of credit and what type are they? Clear? How old are your lines of credit and what type are they? Do you have a good mix or is it? Say all credit cards. Clear? Basically you can say that basically you are taking housing loan, vehicle loan and credit card. It is, you can say that your credit score is a little bit good. Clear? But you can say that basically you are taking credit card of first company, credit card of second company, credit card of third company, and also you are taking payback offer or later payback of Amazon. Clear? Like you have purchased today and you have to pay back after 1 month. Clear? So basically all these things led to your score fall. Clear? All these things led to your score fall. Clear? Because you are taking the facility from different companies, C1, C2, C3, here also for the Amazon, for the Flipkart. Clear? Just basically we are taking the examples here. Clear? Just basically we are taking the examples here of different agencies. Clear? Like C1, C2, C3. Like basically here you will take the ICICI, you will take the SBI, you will take the HDFC. Fourth one, basically you will take the Amazon. Fifth one, basically you will take the Flipkart. Clear? Sixth one, you will take the Axis. Clear? So basically it leads to your score fall. Clear? It leads to your score falls. Clear? So a history of consistent repayment. Clear? A history of consistent repayment of various types of credit will improve your credit score. Clear? Basically will improve your credit score. Clear? So all these basically comes under the managing the credit score. Clear? Managing the credit score. So next is what is the positive side of the credit score. Clear? What is the positive side of the credit score? Clear? Now basically we have to discuss basically what is the positive side of the credit score. Clear? So a good credit score. Clear? A good credit score will indicate the character of the borrower. Clear? A good credit score basically will indicate the character of the borrower basically in his financial matters. Clear? Basically in his financial matters. Like evidence of financial discipline, that is basically the person is paying the installment on times. If the borrower has defaulted once or twice, basically due to the reasons beyond their control, those would show up as a clear aberration in an overall consistent payment history. Clear? Like sometimes, like basically due to the COVID. Earlier, basically we can say that basically borrower take the loan in 2012 and properly done the repayment in 2016. Clear? But due to the COVID, basically when the borrower takes the loan in 2019. Clear? So basically some installments are missed. Clear? So basically these are some of the reasons basically beyond their control. Clear? So these would show up as a clear aberration in an overall consistent payment history. Clear? So basically we will take the other loan, check other loans also. Clear? Whether that customer in the previous times is good or not. Clear? So the longer the credit history, clear, the longer the credit history, it is the better. The lender's assessment presumably improves as he gets bigger spans of repayment. Clear? As he gets bigger spans of repayment. Clear? One should be judicious about closing old accounts and opening new ones. Clear? It is not say that better. Clear? Like you are closing your old accounts and opening new ones. Clear? So one should be judicious basically about closing the old accounts and opening the new ones. And the score. normally ranges between 300 and 900, and 800 plus is considered as a good score, clear, and 800 plus is considered as a good score, but this may vary from bank to bank, clear, but this may also vary from a bank to bank, clear. Now basically we will discuss basically what are the warning signs in the credit score, clear, basically what are the warning signs in the credit score, clear. First one is the behavioral pattern of the borrower. Clear, the behavioral pattern of the borrower will impact the credit score of the borrowers. Clear, the behavioral pattern of the borrowers. Like basically, first one is the craving for credit. Clear, craving for credit. That is basically always want more and more loan. Clear, always want more and more loan. Clear, in simple language we can say that. Second one is frequent and unnecessary shopping for credit. Clear, basically frequent and unnecessary shopping for credit. Third one is basically you will find that in many cases, clear, basically when the person withdraw the cash from the credit card, clear, withdraw the cash from the credit card on continuous basis, clear, it also lets to fall in the CIBIL score, clear, it also lets to fall in the CIBIL score, clear. There are basically sometimes you will find in the newspaper articles on that also, clear, basically how the credit card, clear, basically will reduce the CIBIL score, clear, like we can say that you are not paying the installment, or basically we can not paying the payment on due date, clear, in the credit card, it also lets your CIBIL score fall, clear, or basically you are taking continuously cash withdrawal from the credit card, clear, it also lets to sometimes basically fall in the CIBIL score, clear. Several new accounts, clear, several new accounts or recent requests for the loans, clear, or recent requests for the loan can be taken as a sign of an over hungry borrower, clear. Several new requests, several new accounts or requests, recent requests basically for the loans can be taken as a signs of an over hungry borrower. The length of the credit history, clear, the length of the credit history is also important, clear. Older accounts are generally better, clear, older accounts are generally better, so you should be judicious basically about closing the old accounts and opening the new ones, clear, about closing the old accounts and opening the new ones, clear. So that are, these are some of the warning signs in the credit score, clear, these are some of the warning signs in the credit score, clear. Now next basically we have to discuss the credit information companies in India, clear, which one of the companies are basically working in India, clear, as a credit information companies, clear, credit information companies, clear, very, very important, because in India, basically there are 4 credit information companies basically that are recognized by the RBI. So presently 4 CICs. First one is the TransUnion CIBIL Limited, clear, first one is the TransUnion CIBIL Limited. Second one is the Equifax Credit Information Services Private Limited, clear, Equifax. Third one is the Experian Credit Information Company of India Private Limited, clear. Third one is the Experian. Fourth one is the CRIF High Mark Credit Information Services Private Limited, clear, have been granted certification of registration by the RBI, clear. So in the examination, basically sometimes they will ask basically how many credit information companies? 4. First one is the CIBIL. Second one is the Experian. Third one is the CRIF. Fourth one is the Equifax. Clear, fourth one is the Equifax, clear. Further CICs, clear, basically further CICs and CIs, clear, credit information shall keep the credit information collected and maintained by them updated regularly. One more question, clear, one more question here, basically up in within how much time, clear, updated regularly basically on a monthly basis, clear, updated regularly on a monthly basis or at such a shorter intervals, clear, updated regularly basically on a monthly basis or at such shorter intervals as may be mutually agreed, clear, or at such shorter intervals as may be mutually agreed, clear, as may be mutually agreed upon between the, clear, upon between the credit institution and credit information companies in terms of the regulations, clear, of the credit information companies regulation 2006, clear, 2006, clear. Basically you have to remember basically which of the following 4 agencies are working in India, and basically they have to keep the information updated on a monthly basis, clear, or at shorter intervals, clear, or at shorter intervals, clear, as may be mutually agreed basically upon between the credit institutions and the credit information companies, clear, and the credit information companies, clear. So now basically what are the benefits of using credit information report, clear? So what is the benefit of using the credit information report, clear? So basically generally in the banking sector, clear, basically you will use a CIBIL, CRIF, Experian, Equifax, clear, Experian, Equifax, clear. These 4 are generally basically used. and CIBIL is the most common here. Clear? CIBIL is the most common here. So basically, what are the benefits of using credit information report? First one is it helps in analyzing your true financial standing and makes plan for the future finances. Clear? And makes plan for the future finances. Clear? So one can be on top of your borrowings and avoid debt traps. Clear? And avoid debt traps. Clear? So while with the credit information report in hand, he or she basically will be in a good position. Clear? He or she basically will be in a good position to make decisions regarding availing new forms of credit. Clear? While also being able to extract. Clear? Basically, while also being able to extract the best possible rates from banks or from other lenders. Clear? Basically, it depends upon your credit score. Clear? It all depends upon your credit score. Clear? A credit information report. Clear? Further, it helps us in cultivating financial discipline. Clear? Further, it helps in cultivating financial discipline. Clear? Further, it helps in cultivating financial discipline. Next one here, basically, what are the factors leading to favorable good credit score? Clear? Basically, what are the factors leading to favorable credit score? Clear? What are the factors basically leading to favorable credit score? So first one is on time loan EMI payments. Say like you are paying your installments on the time. Second one is regular payment of the credit card bills. Clear? Second one basically which we have to discuss here, that is regular payment of the credit card bills. Third one here basically that is paying credit card bills in full rather than paying the minimum amount due. Clear? Every time. Clear? Some person basically what they will do, basically they will pay the minimum amount due. Clear? Rest they will not pay. Clear? So basically it also lets you fall in the score. Clear? It also lets you fall in your credit score. Clear? Basically regarding all these things, basically we have to discuss in chapter number 9 in detail. Clear? In detail, because every year, clear, basically you will find that questions on the credit score. Clear? Question on the credit score. Clear? Either you will find case study or 2 to 3 mark question basically on the credit score. Clear? Very easy question, but you have to understand the concept once. Clear? Next one is avoid over leveraging. Clear? That is basically avoid over leveraging. That is basically too much debt. Clear? Too much debt. Next one is basically maintaining strong financial records. Clear? Maintaining strong financial records. Clear? Or last one is basically too many forms of credit. Clear? Such as unsecured personal loans. Clear? Among the family members. Clear? It also leads to the fall. So proper utilization of approved credit limit. Clear? Proper utilization of the approved credit limit. It also leads to the favorable credit score. Clear? Favorable credit score. Clear? So you have to take care regarding all these things basically, so that your credit score is good. Clear? So that your credit score is a good. Clear? So all these things basically we have discussed here regarding the credit score. Clear? Some points basically we have left, that basically sometimes basically the wrong details is showing in the credit report of any person. Clear? Like mobile number is belong to any other person, or there is Aadhaar card or PAN card is of any other person. Clear? So it's less to the fall in the credit score. Clear? That is basically issuing in credit scores. Clear? Issues in the credit score or mistakes in the credit score. Clear? And basically how we can rectify these credit scores. Clear? Or how we can rectify these credit score. Clear? All the things basically we have to discuss in the next session. Along with that, basically we have to discuss in the next session 10 questions on the basis of that. Clear? 10 questions on the basis of that, including some previous year questions. Clear? Basically which they have already asked in the examination from this chapter. Clear? Basically we have to discuss in the next session. Clear? So thanks to all of you for joining this session. Hope it is clear to all of you regarding all these points. Clear? They have directly asked these points in the examination. Clear? They have directly asked these points in the examination. Clear? So you have to take care regarding all these points. Clear? So here basically we have to discuss one important thing. Clear? Basically which they have asked. Clear? So basically regarding the credit scoring model. Clear? Regarding the here regarding good credit score. Clear? So basically here basically we have discussed what is the credit scoring model. So basically basically we have discussed basically which of the factors. Clear? It depends. Clear? Which of the factor it depends. Here I think basically I will find that. Clear? Basically credit scoring model. Clear? Basically on which weightage. Clear? It is asked. Clear? Basically maximum weightage like payment history, amount owed, length of credit history, new credit, types of credit in use. Clear? In some books, clear, basically they have not mentioned this one. Clear? So basically in that basically what they have given credit scoring model. Clear? As a topic. So basically this question they have already asked in the examination. Clear? This is one of the previous question basically which of the following basically they are asked basically credit scoring model. Clear? Basically which factor they will consider. So basically there are three factors under that. Clear? First one is the basically default on previous credit transactions. Clear? Default on previous credit transactions. Second one is basically payment behavior or payment history. Third one is basically previous searches or inquiries. Clear? Previous searches or inquiries. Clear? Or inquiries. Clear? So basically they have asked question on that. Clear? So basically they are asking basically which of the following are not included under the credit scoring model. Clear? So this one is included. Default on previous credit transaction. Second one, payment behavior or payment history is included. Previous searches or inquiries is included. Clear? So fourth one, basically they will ask any other point. Clear? So you have to remember all these points. Clear? So you have to remember all these points while answering the question. Clear? Because they will ask question from these points already in the examination. Clear? So thanks to all of you for attending this session. In the next session, basically we have to discuss some questions along with the concept.